All right. Good morning, everybody. Good morning, all you magnificent melon heads. Happy Wednesday. Got that one right today. Happy Wednesday, everybody. Today is November 19th, 2025. It's Nvidia Day. It's that day where Jensen Huang comes out of his hole, and if he sees his shadow, it means the bubble, 3 more months of bubble. If he doesn't see his shadow, it means the bubble pops and it's 2000 all over again. We're just going to have to wait and see, guys. Now, look, Nvidia earnings after the bell today, they're going to be good. All right, we know. We could see OpenAI lost $12.9 or $12.6 billion last quarter. Where'd that money go? Probably to Nvidia. All this silly circle jerkonomics that's going on across the economy, all that money ultimately is being funneled into Nvidia sales. So we know they're going to be good. All right, so that's not even like up for debate at this point. I'd be really surprised to see Nvidia miss here. I'd be really surprised. There have been some things like CoreWeave and Supermicro reporting delays in some orders, and those SSI, or was it ISS? I don't remember the name of that obscure server maker that does all their work with Dell that reported last week. There's been some stories of delays at data center projects. Maybe that filters through, but I think that's a very, very slight possibility. All indications are Nvidia's earnings are going to be good once again. Now, here's my point, and this is one of the reasons why I am personally short Nvidia, so put that asterisk next to everything I say about Nvidia. You have to keep that in mind. The market may not care. All right, Nvidia earnings are going to be good. The market maybe doesn't care about that. Look at what happened with Palantir earnings. By all measures, Palantir earnings were phenomenal, and the market called bullshit anyway. And if you look at this sell-off that started in the NASDAQ, it started on November 3rd, right when Palantir reported earnings. So just reporting good earnings ain't enough anymore. The law of large numbers has taken over. We all know this isn't sustainable. We all know the AI economy is a circle jerk. It is the largest accounting fraud in history. Now, I think there's like one guy in Sheboygan who still thinks it's legitimate. Other than that, everybody else is either lying through their teeth or smart enough to realize what it is. It's nice of you guys to come around 2 years after I said that, by the way. The question is, will the market call BS on Nvidia's earnings? And I don't know. They may or they may not. But I can tell you yesterday, the market called BS on the latest circular deal among AI market participants. We had a big announcement yesterday between Microsoft, Nvidia, and Anthropic. Stop me if you've heard this one. Microsoft and Nvidia are going to give a whole bunch of money to Anthropic so Anthropic can afford to buy Nvidia chips and rent Microsoft data centers. Oh, you have heard this one. That's right, because it's the same thing they did with OpenAI. It's the same thing they do with CoreWeave. It's the same thing they're all doing, just passing money around in circles, reporting it as revenue every time, the same dollar going around and around and around, and just using that to bid up their stocks. Well, it's funny. As they're trying to pump those numbers right before Nvidia's earnings yesterday, Microsoft and Nvidia stock both closed in the red yesterday. It's not working anymore. So I don't know what's going to happen after the bell today. I'm leaning one way, obviously, and I've made my own bet in that regard. But there's some indications that maybe, at risk of sounding cliche, this time will be different. Now, meanwhile, as the world's all like, oh, what's going to happen with my big accounting fraud and my AI Ponzi scheme is it's so wonderful over here. The real economy is over this way. Retail earnings this morning. Yikes. All right, we've got earnings showing that the real economy, people buying real things with real money for use based on their earnings and wages and things, not all that circular crap that's going on in Silicon Valley. The actual economy of stuff is in bad shape. Let's start with Target. Terrible earnings from Target. Comparable store sales down 2.7%. Foot traffic down 2.2%. Average transactions down 0.5%. What does that mean? You've got fewer people shopping. The ones that are shopping are buying less stuff. And so the stores are selling less, even though inflation is still at 3%. They're taking in 2.2% less money. That is a dreadful report for Target. And the CEO doesn't know when it's going to get better. They also cut their outlook. Meanwhile, we've got Lowe's stagnant. Home improvement retailer reported comps up 0.4%. That is roughly in line with the 0.2% increase we got in Home Depot's comps yesterday. But that's not enough, guys. You got 3% inflation. Actually, who knows what inflation is, because we haven't had a CPI in 2 months. For all we know, it's 4.5%, 5% by now. Probably not that bad. But look, doing 0.4% growth in comps when inflation is 3%, that means less stuff is selling. They also revised their sales. They raised their sales guidance, but they're projecting flat comparable sales, and they cut their profit guidance. So when you raise your guidance for sales, but you cut your guidance for profits, that means your margins are getting crushed. Maybe a little bit of tariffs showing there in the projections at Lowe's. And then the last one we got was TJ Maxx earnings, and they were good. And that's not great, Bob. When TJ Maxx earnings are good and everybody else is doing terrible, that means people are broke and they're out there treasure hunting. And TJ Maxx is the kind of store you go to when you're trying to save money by not shopping somewhere else. TJ Maxx has comps up 4%. They raised their outlook. So look, Target and Lowe's sucks and TJ Maxx is killing it. This is not a good sign for the American consumer. And everybody's just bloviating about Nvidia's circle jerk while the real economy goes to shit. Something we've been talking about on this channel for, 2 years. Other things going on this morning. The interesting one from Stellantis supplier CLN, which stands for something in Italian that I'm not even going to try to pronounce. CLN is close to a deal to restructure their debt. This supplier, they make things like wheels and sheet metal for car body panels. This company has been in big trouble. It's a main supplier of Stellantis. They are cutting a deal that's going to see the banks take about a 50% haircut on the debt they're holding for CLN. And in exchange for this deal, apparently Stellantis is going to be buying plants in Poland and Brazil. So look, Stellantis has been pretty much hiding their losses on the balance sheet of one of their suppliers. That supplier is now going belly up. The banks are going to take a 50% haircut. Stellantis is bringing most of that supplier's operations in-house, which means if they are going to keep losing money, it's going to show up on Stellantis's numbers. Now, this is just another example of the car industry is in really bad shape here. See also earlier comments about the real economy going to hell in a handbasket. Also, going on this morning, we've got the Dutch are giving Nexperia back to the Chinese. In other words, China won that one. The Dutch decided, hey, we're going to seize this auto chip maker because we don't like something they're doing over in China. The United States told us to do it, so they seized the company. China said, no chips for you. Europe said, oh, crap, we can't make cars without those chips. See also the earlier problems at CLN. And so the Dutch said, all right, China, you can have it back. There's no other way to interpret that other than the Chinese won that one. Divorcing yourself from China in the world of manufacturing sounds a lot easier than it really is in theory. Meanwhile, the Chinese are absolutely throwing a fit over Sanai Takaichi's comments about Taiwan. That's Sanai Takaichi is the new prime minister in Japan, and she made some comments about how, China shouldn't invade Taiwan, and if they do, Japan might get involved militarily. And now China is just throwing a fit. They're like, we're not going to buy any beef from Japan. We're not going to let any Japanese movies in our theaters until the Japanese prime minister says she's sorry. Oh, wow, China's awful sensitive about that whole Taiwan thing, the whole prospects for World War III. Hey, China, you want to show me on this doll where the mean lady's words hurt you? How about you don't invade Taiwan and start World War III and we all just go about our lives and do business? Oh, I'm sorry. I forgot. I'm talking to communists. Silly rabbit. Also going on this morning, we've got the U.S. government is going to be loaning money to Constellation for the restart of 3 Mile Island. That's interesting because, the whole electricity prices are going vertical for everyday people. Residential electric rates are going up as all the power is going to the data centers. And the government is giving money to Constellation, my former employer, by the way, to restart 3 Mile Island so they can give all that power to Microsoft for a new data center. Not for your power, for your house to get cheaper. No. This is going to the place for the data center. By the way, they're renaming 3 Mile Island the Crane Energy Center after Chris Crane, who was just about the worst CEO to ever run nuclear plants, at least in my career he was. But I digress. And last but not least, we got one in Bloomberg, all about how private equity is swiping your retirement. And, well, even if you don't like it, there's not much you can do about it. And I read this article, and I'm just thinking, I don't get it. Why are they confessing? And then right out of The Big Short, they're not confessing. They're bragging. We got a lot to talk about today, guys. Why don't we shrink my big melon of a head and let's see what's going on in the world of finance. As always, don't forget that like button for the YouTube algorithm. And you new guys, hit that subscribe button so you can come back tomorrow and have your coffee with the melon heads, because we do this one every single day. And right now, the S&P 500 is just barely positive. We were pretty deep in the green this morning, starting to roll over on the chart here, up 7 points or 0.11% ahead of the open. The Dow also just barely clinging to positive territory, up 18 points or 0.04% higher ahead of the open. And the NASDAQ's doing a little better than the other two, up 43 points or 0.18% in the green this morning. So stocks are up across the board, just barely. Meanwhile, the U.S. dollar is a little bit stronger this morning, up 23 basis points, 99.82. I think that's got a lot to do with the yen. Put a pin in that. We'll be on it for a minute, guys. You got to keep an eye on what's going on in Japan. Looking over at the bond market, we've got yields are lower across the board. The 30-year yield, 4.737%. That is lower by about a half a point. The 10 years at 4.110, off by 1 basis point. The 2 years at 3.568, off by a point and change. And the 1 month is at 3.925. That's lower by 1.5 basis points this morning. All right, we were talking about Japan, guys. Keep an eye on what's going on in Japan, because they just passed this, or not, they're not passing it. They're trying to pass this new stimmy. You got a new prime minister, Sanai Takaichi, and besides getting the Chinese panties in a bunch, she's also pushing a lot of stimmies for Japan, which is modern monetary theory run amok. And the Japanese yen has been weakening ever since she got elected. This is USD JPY, the number of yen it takes to make $1 US. And when you see this chart going higher, that is the Japanese currency getting weaker. And you can see here, ever since Halloween, the yen has been getting weaker, making another big move today, 156 yen to the dollar. Also important is to keep an eye on borrowing costs in Japan. Check out the 40-year Japanese government bond yield. It is hitting an all-time high this morning, 3.72%, up 5 basis points. And much like the weakening of the yen, we have seen this just going up in a straight line here. Ever since Takaichi took over, the Japanese bond market is throwing a fit over the stimulus. And I would refer you guys to that video I did yesterday with Mario and Echo from Echo64. Mario, an incredibly smart guy, came on the channel yesterday talking all about how we may be entering a multi-decade-long bond bear market. And the reaction of the Japanese yen and the JGB market ever since Takaichi took over is a pretty good indicator that Mario is onto something. And let's just zoom out a little bit so you guys can see. Look, this is long-term borrowing costs in Japan hitting their highest level ever. And boy, that is an ugly, ugly looking chart. And remember, Japan is a source of capital. People borrow yen cheaply, convert it into dollars, and buy assets, inflating the everything bubble. It's called the yen carry trade. Well, as borrowing costs in Japan go higher and higher, that trade gets less and less profitable. So it's worth keeping an eye on what's happening in the Japanese debt market. Looking over at the commodities board, check out the shinies this morning. Good morning for precious metals. Hello, spot gold, $4,116. That's higher by $49.56 or 1.22% to the upside. Interestingly enough, look at the December gold futures, that COMEX price in New York, $4,119. Only $1 of contango here between the New York and the London price. $1. That got skinny real fast. And actually, very briefly this morning, gold was actually in backwardation with the spot price right now, just a little bit higher than the New York price in December. We saw that with silver. We saw the spot price went $3 higher than the front month futures contract during the silver squeeze in October. Can we call it the silver squeeze 2.0 in October? Now we're starting to see some early signs of the same thing in gold. Now, gold is a lot easier to move across the pond. It's a lot lighter, at least on a dollar value basis, than silver is. So I don't anticipate we see gold going deeper into backwardation here, but keep an eye on that. If you see that New York price going higher or if you see that London price going higher than the New York price in any kind of big way, that's indicative of short-term supply stress, meaning higher prices on the horizon. Meanwhile, silver is ripping this morning as well. 51.84 for spot silver, up $1.13 or 2.25% higher. Overnight, we hit a high of 52.47. Silver's ripping this morning. December silver futures 51.62. That's higher by $1.09 or 2.17%. I like the shiny. Metals are having a good morning here. Copper's higher by 0.75%. Platinum is higher by about 0.9%. Palladium is the lone metal that's in the red here this morning, down about 0.33%. And crude oil is slowing big this morning here, off by $1.62, 59.05 a barrel for January WTI futures. That's lower by about 2.7%. Signs of economic slowdown weighing on oil here. Meanwhile, let's take a look at Bitcoin. We're sitting here around 91,236, a little bit lower than we were this time yesterday, still within the band of that big sell-off that we had Sunday night into Monday. I guess it was Monday into Tuesday, actually. Man, I am not doing good with the days of the week here this week. I apologize for that, guys. But Bitcoin's still not looking so good here. Interesting story in Bloomberg this morning about Bitcoin. We've got Bitcoin slide spurs record withdrawals from BlackRock's IBIT. That is the biggest Bitcoin ETF. Investors pulled more than $500 million from BlackRock's iShares Bitcoin Trust, the largest single-day outflow since the fund's debut, marking the latest blow to a digital assets market already short on confidence. BlackRock saw $523 million in outflows from the ETF on Tuesday, marking a fifth straight day of net redemptions and its highest on record, according to data compiled by Bloomberg. The downturn came alongside an almost 30% fall in Bitcoin from its all-time high set in October, slumping on Tuesday to its lowest point since April. The token recovered slightly to trade at around 91,628 as of 6:22 a.m. in New York, having fallen as low as $89,232 a day earlier. And you can see in this chart here, guys, this is showing the net flows into BlackRock's IBIT ETF above zero here. That's people buying up ETFs, the ETF buying Bitcoin. And then every now and then you have some net outflows. And here we are. Net outflows are increasing ever since October. Yesterday set a record with $500 million of outflows. Crypto winter is here, guys. Been saying it for weeks, been expecting it for months. It is here. Meanwhile, we got that pre-earnings Nvidia pump going on yesterday. More circle jerkonomics, courtesy of Microsoft, Nvidia, and Anthropic. This one in Bloomberg, Microsoft and Nvidia to invest up to $15 billion in Anthropic, so Anthropic can afford to buy their products. Microsoft and Nvidia are committing to invest up to a combined $15 billion in Anthropic in a move that ties the AI developer closer to two of the biggest backers for its rival, OpenAI. OpenAI is on the brink of bankruptcy by some accounts, and so I guess they're trying to hedge their bets by pumping money into Anthropic now. The investment will be part of Anthropic's next funding round, according to a person familiar with the matter who spoke on condition of anonymity because nobody names their sources. Anthropic has also committed to purchase $30 billion of computing capacity from Microsoft's Azure cloud service, the company said on Tuesday. And Microsoft and Nvidia are giving Anthropic $15 billion, and Anthropic is giving them $30 billion. Where's Anthropic getting the $30 billion? Well, that's the rub, isn't it? These companies don't have the money they're promising to spend. The money they do have is given to them by their suppliers, so they can hand that money right back to their suppliers in a big round tripping scheme. The deal is part of a growing number of tie-ups that have seen cloud computing and chip providers back leading AI developers, which in turn spend money on services from those same firms. Investors have grown increasingly concerned about these so-called circular AI deals, with some worrying they are clear signs of a bubble. That's because they are. Now, interestingly enough, look at the move in Microsoft yesterday. Microsoft was down 2.7%. This is not the Oracle story from back in September where you announce a circular deal and everybody piles into the stocks. People sold the stocks on this news yesterday. Microsoft down a little bit ahead of the open, $492.13, off by another 0.33%. Even Nvidia sold off a little bit on this one yesterday. It was down 2.8% yesterday. Now, Nvidia is getting most of that back this morning, or some of that back is trading at $184.35 ahead of the open, up 1.65%. We'll just have to wait and see what Nvidia does after the bell, guys. We can postulate and pontificate and bloviate We just won't know until they report. Me, Kevin, will giggle like a schoolgirl at how big the numbers are, and then the market is going to tell us whether or not they agree. Meanwhile, in the real world, the economy sucks. Target cuts profit outlook as shoppers look for deals and make fewer store trips. Target posted a drop in quarterly sales and lowered its full-year profit guidance on Wednesday as the big box retailer saw choppy spending and shoppers hunting for value. Despite its ongoing struggles, Target stuck by its sales guidance for the all-important holiday season, saying it expects sales to decline by a low single-digit percentage in the fourth quarter. That's not good. It said it expects adjusted earnings per share for the year to come in between $7 and $8, lowering the higher end of its previous range of $7 and $9. Much of its new range would come in lower than last year when adjusted earnings per share were $8.86 a share. On a call with reporters, incoming CEO Michael Fidelki declined to say whether he thinks the company's sales would turn positive again, but said he thinks Target's making progress. Okay, so we got that going for us. Earnings per share of $1.78 slightly beat expectations for $1.72. Revenue of $25.27 billion missed estimates of $25.32 billion. Target sales have been roughly stagnant for 4 years as the world has continued to inflate away the currency. And where's that comps data? Here we go. Customers made fewer trips across Target stores and websites and spent less during those visits. Traffic dropped by 2.2% and average transaction amount fell by 0.5% year over year. Fewer people go into the store, spending less money when they do go. Comparable sales, an industry metric that excludes one-time factors like store openings and closings, decreased 2.7%. Again, guys, you got 3% inflation. So if you're already negative 2.7, you can subtract 3 more from that. So they're selling about 6% less stuff than they did a year ago. That's consumers struggling here. The one silver lining, digital sales grew by 2.4%, driven by more than 35% growth of same-day deliveries. So more people shopping online, but that's not enough to make up for the decline in brick and mortar stores. Target stock not looking so good ahead of the open here, down 3.24%, $85.66 for Target shares. And that stock was already down 34.5% year to date. So more pain for Target. This one may be going the way of Kmart, folks. Meanwhile, Lowe's better than Target, but still not good. Lowe's beat on quarterly sales, but lowers full-year profit forecast amid economic uncertainty. Lowe's on Wednesday posted a year-over-year sales increase for the quarter, but the company lowered its full-year profit outlook slightly to reflect tougher economic backdrop. You can see maybe tariffs there, maybe inflation, but certainly margins getting compressed when your sales go up, but your profits go down. That means your profit margins are getting chopped up. The home improvement retailer now expects full-year total sales to be about $86 billion, up from its previous expectations of $84.5 to $85.5 billion. That's because of a recent acquisition. However, it said it expects comparable sales, an industry metric that takes out one-time factors, to be flat compared to a year ago. And that's also compared to a prior range that it said would be flat to up 1%. So Lowe's is lowering their comps because of the frozen housing market. Earnings per share of $3.06 beat $2.97 expectations. Revenue of $20.81 billion. That's a narrow miss compared to expectations of $20.82 billion. Lowe's comparable sales rose 0.4% in the fiscal third quarter. That's nearly identical to the 0.2% growth we saw from Home Depot. And again, in the context of 3% inflation, that is dreadful. Home improvement trends, however, remain challenged by a slower housing market and higher borrowing costs, dynamics that have challenged the sector for more than 2 years. But it looks like the market was expecting even worse than that, because Lowe's is actually holding up all right ahead of the open here. Stock's up 5.2%, $231.30 for Lowe's shares, up $11.42. Although year to date, the stock was already down 11%. So we're still in the red for the year for Lowe's. Now, we got Lowe's and Target are doing terrible here, and TJ Maxx is doing great. And again, TJ Maxx is one of those stores that you don't want to do great because it means people can't afford to shop anywhere else. TJ Maxx owner outperforms, signaling more frugal U.S. shopper. TJX Co. posted sales last quarter above estimates and raised its outlook, signaling that U.S. shoppers are turning to cheaper options as the economy shows signs of stress. The discounter, which runs chains including TJ Maxx and Marshalls, said revenue hit $15.1 billion Analysts had expected about $14.9 billion. Its comparable sales also topped estimates. TJX also raised its guidance for comp sales to a gain of 4% this year, up 1 percentage point from a forecast in August, and it also boosted its earnings outlook. The fourth quarter is off to a strong start, said CEO Ernie Herrmann in the release. Retailers have warned for months that tariffs will increase prices. That would add several years of high inflation. That would add to several years of high inflation and further stretch consumers. But it's also giving companies such as TJX an edge. Its chains sell designer and branded goods at discounts after procuring inventory that hasn't sold at full price stores, which means TJ Maxx is buying older stuff that got here before the tariffs. They're buying on a discount. The tariff doesn't really affect TJ Maxx. It's actually helping them. That stock is ripping this morning, up 3.8%, $151 even for TJX. That's up about $5.50. And year to date, this stock was already up 20.5%. So looking even better now for them. And again, good news for TJX is bad news for everybody else. Meanwhile, we've got this story from Stellantis. Key Stellantis supplier nears a debt deal involving asset sales. A key supplier of Stellantis is nearing an agreement with its lenders to restructure its liabilities, according to people with knowledge of the matter. Stakes in the Italian auto parts maker CLN. Should we try it? Coils Lamer Nastri. Did I get that one? We're going to stick with CLN. All right, let's stay in your lane, Jack. CLN are pushing ahead with a plan that will see banks recover around 50% of their original exposure, said the people who asked not to be identified. Notice the positive spin. Oh, we're going to recover 50%. Well, another way to say that is you're going to lose 50%. You're getting your head cut off with this deal. That will include asset disposals, they added. Its Brazil plant will be sold to Stellantis, while one in Poland could also go the same way, said one of the people. Discussions with Stellantis are still ongoing, the people added. Stellantis has supported CLN by pledging to pay more on its Italian supply contracts than the negotiated price. Spokespeople for CLN and Stellantis declined to comment. CLN makes steel components, including wheels and metal sheets for car makers. Not good here. A 50% haircut on their debt. The people they supply it to are buying some of their plants. That's the only way they're even getting the 50% that the banks are going to recover. The auto industry is in bad shape here. People can't afford cars, just like they can't afford to shop at Lowe's or Target. Meanwhile, more auto news here. The Dutch have surrendered. Netherlands returns control of Nexperia to Chinese owner. No other way to interpret this one, guys. The Dutch government suspended its powers over chipmaker Nexperia, handing back control to its Chinese owner and diffusing a standoff with Beijing that had begun to hamper automotive production around the world. The order that gave the Netherlands powers to block or revive decisions at Nexperia was dropped as a show of goodwill and also a demonstration of weakness, according to Economic Affairs Minister Vincent Carmans said on Wednesday, adding that discussions with Chinese authorities are continuing. The Nexperia Group currently shows no signs of continuing the behavior that prompted my order, nor any intention to do so. Yeah, right. The Dutch state invoked supervisory powers over Nexperia to safeguard crucial technology, citing concerns that actions by Wingtech Technology, the chipmaker's Chinese owner, risked hobbling the company. Nexperia is the last manufacturer with European production capacity for so-called legacy chips, which are crucial in the automotive and consumer electronics sector. A Wingtech spokesperson rejected the accusations by the Dutch government about acts of alleged mismanagement and said no proof had been provided. Nexperia did not immediately respond to an emailed request for comment. That is absolutely Dutch surrender on the Nexperia fight, guys. The Europeans can't make cars without the chips, and when the Dutch seized Nexperia, the Chinese said no chips for you, and all of the automakers went into a panic, and now the Dutch are walking this one back. Meanwhile, China's in the news again this morning. Let's go all the way back to Halloween. This is how it started. Japan's Takaichi and China's Xi agreed to pursue stable ties. All right, that was about 20 days ago. Let's check in and see how it's going today. Meanwhile, China steps up retaliation against Japan with seafood and film bans. All right, so those stable ties, not entirely stable. Thanks, Chewy. Take the professor in the back, plug him into the hyperdrive. China escalated its retaliation against Japan, suspending imports of Japanese seafood and halting approvals for new films. The latest signs that their diplomatic spat is far from over. Chinese Foreign Ministry spokeswoman Mao Ning told reporters on Wednesday that Japan had not met the conditions for resuming seafood shipments, effectively confirming earlier Japanese media reports that imports would be suspended. The move comes just months after Beijing lifted a similar ban. Mao warned that if Tokyo refuses to retract Prime Minister Sanae Takaichi's remarks on Taiwan that angered Beijing, China will take serious countermeasures. Man, the Chinese are awful sensitive about that whole Taiwan thing, huh? Oh, you take that back. I'm going to take my ball and go home if you don't take back the mean things you said about Taiwan. We're going to invade Taiwan, and we want you to be nice about it. Relations between the two neighbors have soured after Takaichi became the first sitting Japanese leader in decades to publicly link a Taiwan Strait crisis with the possible deployment of Japanese troops. Her remarks drew swift retaliation from Beijing, which warned of more to come. Beijing has also suspended talks on resuming beef imports, according to Kyodo News. In addition, Chinese regulators have paused the approval process for new Japanese films and suspended 6 titles that have already been cleared and secured release dates, according to people familiar with the matter. Well, screw them if they can't take a joke. What can I say? Meanwhile, the Trump administration backs 3 Mile Island nuclear restart with a $1 billion loan to Constellation, taxpayer dollars, funding the restart of a nuclear plant so all the power can go to a data center. Look, I have friends that work at 3 Mile Island. I'm glad they're restarting the plant. They never should have shut it down to begin with. See, also, Chris Crane was really bad at his job, even though they're naming the plant after him when he's pretty much the one who sealed the fate of the plant. But I digress. The Trump administration will provide Constellation Energy with a $1 billion loan to restart the Crane Clean Energy Center nuclear plant in Pennsylvania, Department of Energy officials said Tuesday. Previously known as 3 Mile Island Unit 1, the plant is expected to start generating power again in 2027. Constellation unveiled plans to rename and restart the reactor in September of 2024 through a power purchase agreement with Microsoft to support the tech company's data center demand in the region. You'll notice we're loaning money to support Microsoft's data center demand in the region, not to lower your utility bills. Oh, no, silly rabbit. 3 Mile Island Unit 1 ceased operation in 2019, one of the dozen reactors that closed in recent years as nuclear struggled to compete against cheap natural gas. It sits on the same site as TMI Unit 2, the reactor that partially melted down in 1979. The loan would cover the majority of the project's estimated cost of $1.6 billion. The first advance to Constellation is expected in the first quarter of 2026, said Greg Beard, senior advisor to the Energy Department's Loan Programs Office, in a call with reporters. The loan comes with a guarantee from Constellation that it will protect taxpayer money. What is the guarantee? Does that guarantee have any teeth, or is it just we pinky swear to try really hard to pay you back? And if you can guarantee that no taxpayer money is going to be lost, then why does the government need to make this loan to begin with? Why can't you get it from the private sector, where they're just shoveling heaps of money on any project and its cousin involving data centers? It's interesting that the government's getting involved here. And again, why is the government not getting involved in making loans to power plants that might lower our utility bills? Why Microsoft's utility bills? Inquiring minds want to know. Meanwhile, we got this one in Bloomberg this morning. America's nest eggs built a private equity loan revolution. This one's going to make you sick to your stomach, folks. And again, as we're reading through this, I want you to remember that scene in The Big Short. And I said, I don't get it. Why are they confessing? They're not confessing. They're bragging. Private equity managers are desperate for cash. Insurers are lending it out for higher returns and exposing themselves to potentially hard-to-sell assets. What they're not saying is the insurers that are loaning this money out were bought by the same private equity funds that now own them, and they're loaning money to these private equity funds, holding companies, so that the private equity funds can make it look like they're profitable and return cash to investors. Ordinary Americans are helping throw lifelines to private equity funds, whether they know it, whether they like it or not. The insurance and annuity arms of Wall Street powerhouses, including Apollo Global Management, Ares Management, and Carlyle Group, rank among the most active providers of an esoteric type of financing once dominated by banks and specialist lenders, according to market veterans handling the private deals. Apollo's Athene insurance unit alone has pumped roughly $18 billion this year into funding the debts known as NAV loans, or net asset value loans, in which fund managers post their investments or net asset value as collateral. Buyout funds can use the money to shore up portfolio companies, redeploy it into new deals, or seed new funds. Some loans enable payouts to investors who've been waiting years to recoup stakes in hard-to-sell assets. And I've talked about these NAV loans for years now, guys. These private equity firms, they can't sell their companies for what they claim they're worth because nobody's willing to buy them. There's no price discovery. These companies don't make money, and yet they've got investors who are demanding the returns they were promised. So what are they doing is they're borrowing money against these companies, and then they're using that borrowed money to make it look like they have profits to pay out to their investors. And if that sounds like a Ponzi scheme, it's only because that's pretty much what a Ponzi scheme is. But who are they borrowing it from? They're borrowing it from the insurance companies that those same private equity firms just bought. And the insurance companies are loaning your retirement money to themselves so they can pay profits to their investors. This is how private equity robs everyday people. A relatively obscure niche before the pandemic, NAV lending has been gaining momentum the past few years and is now snowballing. The roughly $225 billion of NAV loans outstanding will probably double in the next 2 years and surge as much as sixfold by 2030, according to Kevin Alexander. I don't get it. Why are they confessing? They're not. They're bragging. NAV loans serve as a window into the rapid evolution of private market giants. Their insurance divisions, units that now drive much of their growth, are reaping juicy yields from making loans. A lot of those yields, by the way, are PIK or payment in kind, where they're not actually getting any interest. They're just taking the missed interest payments and adding it to the money owed. Yeah, juicy yields for making loans to buyout funds that once laid the industry's foundations, but now struggle to generate cash from sales of those companies. Some see the loans as a way for those insurers to combine their company's knowledge of corporate buyouts, blah, 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 talking point. No, it's a way to get retirees to foot the bill for your fake profits. What sets the fleet of insurers apart from many other NAV funders is the source of their money. Firms offering life insurance and annuities effectively shepherd the nest eggs of millions of Americans. A series by Bloomberg this week examines how Wall Street firms have taken over part of that industry, shifting more liabilities offshore and expanding into more complex asset classes, even if some retirees don't want their money there. And that's the thing, guys. If you're lucky enough to even know this is happening to your retirement, there's probably not even anything you can do about it. The regulators are just sleepwalking, letting this happen. The Trump administration cleared the way for this with the signing of their executive order to allow this garbage into 401ks and IRAs. And I don't know what to tell people. People tell me all the time, how do I protect against this? Honestly, guys, I don't know what to tell you. All I can tell you is they're definitely robbing everybody in broad daylight, and now they're bragging about it. It sucks. Just sucks. Hey, I just want to say thank you very much to my man, the Pasta Man. What's going on, Nashville? He says, no comment about Callaway selling Topgolf to private equity. First of all, Al, Midnight Al, my cat is attacking my foot as we speak here. Sorry, buddy. All I can tell you is when you get into bed with private equity, that's like the scene in Goodfellas. Once you get into bed in the business with the gangsters because you can't pay your debts, the inventory comes in the front door and it goes out the back door. Topgolf, living on borrowed time here. Private equity bought a big chunk of the company. They're already in financial trouble. Private equity is going to loot this company, bleed them dry. They're going to load the company up with even more debt, pay themselves a dividend with that debt instead of reinvesting in the business. Days are numbered for Topgolf. Thank you, Pasta Man, for supporting the channel, sir. Nacho Man, Randy Savage, thank you, sir, for the generosity. He says, great show with Mario yesterday, Jack. Always great knowledge. Hey, shout out. Thank you very much, Nacho Man. And I'd also like to send a shout out to Mario and Echo. Mario, who was the first guest in the history of my channel, actually helped me out a lot when I was just getting started here. So I always like having Mario on the channel, if for no other reason than that. That and Mario has just forgotten more than I could ever know. He is one of the most well-read people I've ever met, incredibly knowledgeable. He remembers things I didn't even know happened to begin with, a wealth of information. And I agree, he put out a really good show yesterday morning about a bond bear market. And I decided to redo that whole interview around that show because it was really well done. And I think Mario's right about this. I think people who are sitting here thinking, oh, the Fed's going to lower rates. Rates are going lower. Zoom out on the chart, guys. I think rates are going higher for decades to come. There is a reckoning coming in the bond market. Thank you very much, Nacho. Check out that video with me and Mario from yesterday, and check out Moneco 64 while you're at it. Tell them nobody sent you. Hunt and Cover, thank you, sir, for the generosity. I appreciate that. He says, you and Mario, but no cameo from Midnight and Rudy. Well, I can tell you, Midnight is down here wreaking havoc with my feet as we speak, tearing into them. He got some lucky shots in, but I think overall I won the fight. It is really hard to maintain your concentration on a live show and keep the presentation flowing when a cat is mangling your foot in real time. But this is a live show and there's no do-over, so we got to do it. And Rudy, if you listen, it was about halfway through, or there was a couple of times during the interview. I remember when I was doing the editing, you can hear a jingling in the background. I'm pretty sure that was Rudy doing something off camera. So Rudy's audio was in the video if he didn't make an appearance. Thank you very much, Hunt and Cover, for supporting the channel. Rudy is Mario's dog, by the way. Midnight is my cat who loves to attack my feet while I'm live. Hey, Chris Bott, what's going on, brother? He says, tell us what you really think about Constellation and Mr. Crane. Look, Chris Crane, his signature move is he would buy up other utilities and then he would shut down their power generating assets in order to limit supply and drive up prices in the region. And when that didn't work, Constellation would go hat in hand to the state governments or the federal government for subsidies. By the way, PECO, which was it wasn't PECO, it was a ComEd. One of the major utilities that Constellation owned was caught bribing Chicago authorities and Illinois authorities, and they found this one woman took the fall for the whole thing. There's a lot Chris Crane did wrong at the helm at Constellation and when it was Exelon before that. To name 3 Mile Island after him is rubbing salt in the wound of the people whose lives were upended when 3 Mile Island closed. That's just my personal opinion, and I no longer work for the company, so I'm free to air that opinion. It's kind of nice. I don't know. I don't think they should name a plant after the guy. Hey, thank you, Chris Bott, for supporting the channel, sir. Appreciate that very much. Gordon Guanu, you batshit crazy guy, you. He says, thanks for all the extra content you've been making. It is my pleasure, Gordon. Look, the extra content, the other videos and the interviews, a lot of the times that depends on what the news cycle brings us. Sometimes weeks go by where there's nothing that I think warrants a standalone video or anything like that. And then there's, a couple of weeks where years and years of history happens all at once. And these last few weeks, there's been no shortage of stories to talk about. So it kind of depends on what the tide drags in, and the tide has been kind. Thank you very much, Gordon, for supporting the channel. SASHS, thank you, sir, for the generosity. He says, I have a question. You said that you're shorting Nvidia. How big could bubble pop be if it happens? I expect 20 to 30% stocks, but AI 50 or more. Look, the closest parallel to what I see happening with Nvidia is a hardware play, mind you, is the dot-com bubble. And go look at what happened after March of 2000 to names like Cisco, names like Sun Microsystems. Those hardware names, or even Oracle for that matter. And by the way, Cisco just recently recovered its all-time high from March of 2000. It took freaking 25 years to break even on that if you bought at the highs. Those names dropped by 80 to 95% in the year following the bursting of the dot-com bubble after its top in March of 2000. And everything that those hardware people were doing with the fiber cable and everything, it is virtually identical to what NVIDIA and the hyperscalers are doing with their round tripping schemes. So 50% or more, hell yeah. I mean, honestly, if you take away this AI bubble, what is NVIDIA really worth? It's a $20 to a $30 stock if you take away this AI bubble. I'm not saying it's going to go that low, but take away data center demand, which is not supported by any fundamental economics whatsoever. It's only supported by a story that Sam and Jensen has told by the campfire at this point. There is nothing of substance supporting it. And the stock has rallied like 1,400% on that silly campfire story. Take that away, you're left with what? Gaming GPUs. And ask a gamer what they think of NVIDIA. Go look at Gamers Nexus and their last couple of reviews of NVIDIA products. See what that company's really worth without the data center bubble. Yeah, I think it could go a hell of a lot lower than that, SHS. I'm not saying it's going to, but it sure as heck could. We're just going to have to wait until this afternoon. Will Jensen see his shadow and 3 more months of bubble, or will he not see his shadow and it's March of 2000 all over again? We'll just have to wait and see after the bell today. But in the meantime, thank you, SHS, for supporting the channel. And thank you, all you wonderful melon heads, for having your coffee with us this morning. Appreciate that very much. Don't forget that like button and that subscribe button for the YouTube algorithm. Really appreciate all the generosity and the super chats this morning, guys, as well as you magnanimous melon heads on Patreon, YouTube, and Buy Me a Coffee. Thank you guys for supporting the channel with your memberships. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Till next time, live small and dream big.